So I wanted to talk about a little bit of intermarket pairs trading or spread trading. This is basically what hedge funds do. Okay, so we're looking at Regal Entertainment Group. The first thing that we want to do is find a stock that we want to trade. Okay, Regal Entertainment Group, Class A, so on and so forth. We're in the 2-year chart and we see that a large symmetrical triangle has broken out, and that was back in November. And this large symmetrical triangle gives us an upside target of, let's see, this line is about $5 long. Project that from the breakout point, $5 plus the price there is 13, let's just say 13, gives us an $18 price target. Cool, right? Yeah. So now it's at 14.09 and it's making another symmetrical triangle. We might even go so far to call this a flag. And actually it looks like it's right about to break out. See? Right there. And also this is an older strategy that I did, but if you draw the trend lines across the relative strength index, it actually has a breakout and a buy signal. If we jump into the other studies, we have a stochastic sell failure, which is bullish, in this RSI, which is the 7-day. One more up day would be a breakthrough a previous high, but in the meantime we have an ascending triangle forming. So the 7-day hasn't given us a buy signal, but one more up day will. And then finally the momentum index doesn't look like it's helping too much. Yeah, not really giving us anything, the 5-day momentum. So we'll jump back to the actual chart. So what do? We buy once it crosses, let's say, what was that day's high? 14.14. So we'll buy at 14.16. And our target's going to be $18, but in the short term we are going to have a target closer to, let's see, 14.50 down to about 13. We're going to have a target that's closer to, let's see, 14 plus 150, target's 15.50. So short-term target equal 15.50, and the long-term is 18. So we have those two. Okay, so we have basically the trade here. Risk management principles. Let's see, we have an expected gain of, see, this was $1.50. So we have a gain of about $1.35, $1.34. So give us a favorable risk-reward ratio. If we exit below 13.75 with a stop loss, that's going to give us a let's see, 14.16 minus 13.75. That's going to be a 41-cent risk on a $1.35% gain. So that risk-reward ratio is roughly 3, which is passable. So we'll do that. So stop at 13.75. Now in the meantime, this is where it comes to look for a hedge fund. Go to some other stocks that are in the same sector. So hop on a Yahoo Finance, type in RGC, and we go over here, see what we got. Okay, Cinemark Holdings, CNK. Take a look at that chart. We're looking for some technical weakness. We want to short another stock in the same sector. And the reason why we're doing that is because this chart has just been driving everyone insane. So I'm going to try to eliminate market risk. And by doing that, I'm going to short one stock in the same industry while buying another in the same industry. So CNK, that one looks like it just had a buy signal as well. And actually, if you go to the 2-year chart, it's in a huge uptrend. Okay, it's technically strong. I don't want to short that one. So we're back at RGC, which is what we want to buy. So jump back here. Next one is DWA. So DWA. That's DreamWorks. That's what I like to see. So DreamWorks is in a defined downtrend. Even while the market kept climbing, DreamWorks kept crashing. So what do? We will, well, first we'll zoom in here. And looks like we have a defined trend line. So trend line starting from here, going down. And that's a pretty rough guesstimation, but we can say we'll short wherever it is right now. So short around the current price of $18, and we'll get out if it breaks above this trend line. Okay, so what's the worst case scenario? Worst case scenario is that we buy RGC and immediately breaks down to $13.75, causing us a, once again, the math, 30, 25, a 41-cent loss. And for DWA, the worst thing can happen is immediately, and notice this trend line is dynamic, so the further lower it goes, the lower our stop goes. So the trend line is helping us keep our profits for us. Worst thing that happen, $18, it immediately climbs up to $18.75, and we're out with a 75-cent loss. So that's the worst thing that can happen. Do I think that's going to happen? Probably not, unless someone decides to suddenly buy DreamWorks. But keep your stops in place. So that's how you trade like a hedge fund. And other thing you can do is go to, where is it? RGC, look for its beta, which is ownership, financials. I'm looking for key statistics. So key statistics, this is for position sizing. And this is to eliminate market risk. Okay, beta is 0.83, so make a note. I'm just going to draw on this chart. RGC beta equals 0.83. And take a look at DWA's beta. Go down to, once again, key statistics. And their beta is 1.23. 23, and that's DWA's beta equals 1.23. Okay, so we have that and that. So how are we going to use it for position sizing? We're going to buy this. So I'm going to do actually 0.83 divided by 1.23. 0.83 divided by 1.23. And in fractional terms, it gives us 0.67. So, what is this telling us? I'm just going to write 0.67 there. That is telling us that to adjust for market risk, and feel free to post any questions that you have. I'm going through this very quickly. That means for every 1 share of RGC that we're going to buy, because DWA is more volatile, to eliminate market risk completely, and market risk I mean like fluctuations that are caused like by national events. I'm not like, what we're trying to exploit is good management for RGC, bad management for DWA. So for every 1 share that we're buying of RGC, we want to short 0.67 shares of DWA. So let's just say my position, I'm going to, how much is RGC? 1409, so that means I'm going to buy $500. Now we'll go with $1,000 of RGC, and I'm going to short sell $670 of DWA. And that's just to manage your risk more effectively, because if you don't do that, then you're more lopsided to something else. So say I buy $1,000 of RGC and I short $1,000 worth of DWA. That means that even though it's the same price, the same size, because DWA is more volatile, I'm leaning more to the bearish side. Okay, so that is how to trade like a hedge fund. You're not going to make huge profits doing this because you won't have that market premium, but generally it's a little less risky and you'll tend to make profits more often.